But, look, the gap EPS, $1.40 loss, this people's looking for $1.18. I look at that and I say, you know what, let's not forget the idea that we want to see that number go down.
So look, I think it's important when you're looking at our financial statements to kind of make sure that you're not over-indexing to any one particular number, and you're looking at what we're building. And
but
so
a loss is a loss.
A loss is a loss, but a lot of that loss is an impact of tax on GAAP, and it is not a function of the unit level economics that you're seeing as we continue to build and scale the business. And the leverage that you're going to see that you didn't see this quarter has a lot to do with the rate at which we are growing. And you're going, as you didn't see it this quarter, and you're not going to see it in Q2, what you are going to see as we get towards the back of 2026, an enormous acceleration of that leverage that everybody's waiting for. And so when we went through earnings, we went ahead and we reaffirmed, and we are very confident in our revenue numbers for 2026. We are very confident in our operating margin that we're going to exit the ARR and our operating margins for 2026. There's no part of this that surprised us. We understand the physical ramp associated with bringing compute to market. You're seeing it work through the numbers, and you're going to see an inflection as you move through Q3 and Q4 of this year.
If you're taking your cue from the debt market, is that a way of saying the equity is not a good tell?
So I'm saying is that the debt markets are really dialed into the unit economics, and we've talked about this. I've talked about it in earnings, where they're looking at the underlying building block deals, and they're saying, hey, these guys, they're going to hit mid-20s on the unit level deals, and that mid-20s is going to work its way back through the company, and that the equity market is going to see that, but the debt markets already see it because they're focused at the building block debt level, and this is great paper to underwrite. We can underwrite it at investment grade paper.
Yeah, no, they, as you say, piling into your debt and equity. I wanted to take a step back, if I can, and sort of just get a sense for what you're seeing in terms of the changes taking place in the data center itself. I believe you said that more than 50% of your compute now you think is being used for inference rather than training. Been trying to learn a lot about that recently because of the compute needs of it and the fact that when you're using these agentic tools, the workflow chains roughly 20 times the requests of a single shot completion. I don't know if that's true. What does it mean?
Yeah. So it's very, very exciting because what you're seeing is acceleration of demand coming from multiple vectors simultaneously. And when you talk to people across the space, when you talk to Anthropic and OpenAI and Perplexity and all of these different folks, they're talking about this incredible demand that they're seeing. And the way I look at it is we're getting hit by this wall of demand from our existing customers that are coming back to us and saying, you've got the best product, we need more of it. That's incredibly powerful for us. And when I think about it, we win the day, right? When a customer comes back to me and says that, we win the day, right?
Cost per token is coming way down.